Charlie Munger. The architect of Berkshire Hathaway. Charlie Munger died on November 28, just 33 days before his 100th birthday. Though born and raised in Omaha, he spent 80% of his life domiciled elsewhere. Consequently, it was not until 1959, when he was 35, that I first met him. In 1962, he decided that he should take up money management. 3 years later, he told me, correctly, that I had made a dumb decision in buying control of Berkshire. But, he assured me, since I had already made the move, he would tell me how to correct my mistake. In what I next relate, bear in mind that Charlie and his family did not have Hathaway invested in the small investing partnership that I was then managing, and whose money I had used for the Berkshire purchase. Moreover, neither of us expected that Charlie would ever own a share of Berkshire stock. Nevertheless, Charlie, in 1965, promptly advised me, "Warren, forget about ever buying another company like Berkshire. But now that you control Berkshire, add to it wonderful businesses purchased at fair prices, and give up buying fair businesses at wonderful prices. In other words, abandon everything you learned from your hero Ben Graham. It works, but only when practiced at small scale." With much backsliding, I subsequently followed his instructions. Many years later, Charlie became my partner in running Berkshire and repeatedly jerked me back to sanity when my old habits surfaced. Until his death, he continued in this role, and together we, along with those who early on invested with us, ended up far better off than Charlie and I had ever dreamed possible. In reality, Charlie was the architect of the present Berkshire, and I acted as the general contractor to carry out the day-by-day construction of his vision. Charlie never sought to take credit for his role as creator, but instead let me take the bows and receive the accolades. In a way, his relationship with me was part older brother, part loving father. Even when he knew he was right, he gave me their ins, and when I blundered, he never reminded me of my mistake. In the physical world, great buildings are linked to their architect, while those who had poured the concrete or installed the windows are soon forgotten. Berkshire has become a great company. Though I have long been in charge of the construction crew, Charlie should forever be credited with being the architect. R. Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Incorporated. Berkshire has more than 3 million shareholder accounts. I am charged with writing a letter every year that will be useful to this diverse and ever-changing group of owners, many of whom wish to learn more about their investment. Charlie Munger, for decades my partner in managing Berkshire, viewed this obligation identically and would expect me to communicate with you this year in the regular manner. He and I were of one mind regarding our responsibilities to Berkshire shareholders. Writers find it useful to picture the reader they seek, and often they are hoping to attract a mass audience. At Berkshire, we have a more limited target: investors who trust Berkshire with their savings without any expectation of resale, resembling in attitude people who save in order to buy a farm or rental property rather than people who prefer using their excess funds to purchase lottery tickets or hot stocks. Over the years, Berkshire has attracted an unusual number of such lifetime shareholders and their heirs. We cherish their presence and believe they are entitled to hear every year both the good and bad news, delivered directly from their CEO and not from an investor relations officer or communications consultant forever serving up optimism and syrupy mush. In visualizing the owners that Berkshire seeks, I am lucky to have the perfect mental model, my sister Bertie. Let me introduce her. For openers, Bertie is smart, wise, and likes to challenge my thinking. We have never, however, had a shouting match or anything close to a ruptured relationship. We never will. Furthermore, Bertie, and her 3 daughters as well, have a large portion of their savings in Berkshire shares. Their ownership spans decades, and every year Bertie will read what I have to say. My job is to anticipate her questions and give her honest answers. Son. Bertie, like most of you, understands many accounting terms, but she is not ready for ACPA exam. She follows business news, reading 4 newspapers daily, but doesn't consider herself an economic expert. She is sensible, very sensible, instinctively knowing that pundits should always be ignored. After all, if she could reliably predict tomorrow's winners, would she freely share her valuable insights and thereby increase competitive buying? That would be like finding gold, and then handing a map to the neighbors showing its location. Bertie understands the power, for good or bad, of incentives, the weaknesses of humans, the tells that can be recognized when observing human behavior. She knows who is selling and who can be trusted. In short, she is nobody's fool. So, what would interest Bertie this year? Operating results, fact and fiction. Let's begin with the numbers. The official annual report begins on K1 and extends for 4 pages. It is filled with a vast amount of information, some important, some trivial. Among its disclosures, many owners, along with financial reporters, will focus on page K7 too. There, they will find the proverbial bottom line labeled net earnings, loss. The numbers read $90 billion for 2021, $23 billion for 2022, and $96 billion for 2023. What in the world is going on? You seek guidance and are told that the procedures for calculating these earnings are promulgated by a sober and credentialed Financial Accounting Standards Board, FAS, mandated by a dedicated and hard-working Securities and Exchange Commission, SEC, and audited by the world-class professionals at Deloitte & Touche, D&T. On page K67, D&T pulls no punches. In our opinion, the financial statements present fairly, in all material respects, italics mine, the financial position of the company, and the results of its operations, for each of the 3 years in the period ended the 31st of December 2023. So sanctified, this worse than useless net income figure quickly gets transmitted throughout the world via the internet and media. All parties believe they have done their job, and, legally, they have. We, however, are left uncomfortable. At Berkshire, our view is that earnings should be a sensible concept that Bertie will find somewhat useful, but only as a starting point in evaluating a business. Accordingly, Berkshire also reports to Bertie and you what we call operating earnings. Here is the story they tell. $27.6 billion for 2021, $30.9 billion for 2022, and $37.4 billion for 2023. The primary difference between the mandated figures and the ones Berkshire prefers is that we exclude unrealized capital gains or losses that at times can exceed $5 billion a day. Ironically, our preference was pretty much the rule until 2018, when the improvement was mandated. Galileo's experience, several centuries ago, should have taught us not to mess with mandates from on high. But, at Berkshire, we can be stubborn. Make no mistake about the significance of capital gains. I expect them to be a very important component of Berkshire's value accretion during the decades ahead. Why else would we commit huge dollar amounts of your money, and Bertie's, to marketable equities just as I have been doing with my own funds throughout my investing lifetime? I can't remember a period since the 11th of March 1942, the date of my first stock purchase, that I have not had a majority of my net worth in equities, US-based equities, and so far, so good. The Dow Jones Industrial Average fell below 100 on that fateful day in 1942 when I pulled the trigger. I was down about $5 by the time school was out. Soon, things turned around, and now that index hovers around 38,000. America has been a terrific country for investors. All they have needed to do is sit quietly, listening to no one. It is more than silly, however, to make judgments about Berkshire's investment value based on earnings that incorporate the capricious day-by-day, and, yes, even year-by-year movements of the stock market, as Ben Graham taught me. In the short run, the market acts as a voting machine. In the long run, it becomes a weighing machine. What we do. Our goal at Berkshire is simple. We want to own either all or a portion of businesses that enjoy good economics that are fundamental and enduring. Within capitalism, some businesses will flourish for a very long time, while others will prove to be sinkholes. It's harder than you would think to predict which will be the winners and losers. And those who tell you they know the answer, usually either self-delusional or snake oil salesmen. At Berkshire, we particularly favor the rare enterprise that can deploy additional capital ATHI returns in the future. Owning only one of these companies, and simply sitting tight, can deliver wealth almost beyond measure. Even heirs to such a holding can, sometimes live a lifetime of leisure. We also hope these favored businesses are run by able and trustworthy managers, though that is a more difficult judgment to make, however, and Berkshire has had its share of disappointments. In 1863, Hugh McCulloch, the first comptroller of the United States, sent a letter to all national banks. His instructions included this warning: never deal with a rascal under the expectation that you can prevent him from cheating you. Many bankers who thought they could manage the rascal problem have learned the wisdom of Mr. McCulloch's advice, and I have as well. People are not that easy to read. Sincerity and empathy can easily be faked. That is as true now as it was in 1863. This combination of the two necessities I've described for acquiring businesses has for long been our goal in purchases, and, for a while, we had an abundance of candidates to evaluate. If I missed one, and I missed plenty, another always came along. Those days are long behind us. Size did us in, though increased competition for purchases was also a factor. Berkshire now has, by far, the largest GAAP net worth recorded by any American business. Record operating income and a strong stock market led to a year-end figure of $561 billion. The total GAAP net worth for the other 499 S&P companies, a who's who of American business, was $8.9 trillion in 2022. The 2023 number for the S&P has not yet been tallied, but is unlikely to materially exceed $9.5 trillion. By this measure, Berkshire now occupies nearly 6% of the universe in which it operates. Doubling our huge base is simply not possible within, say, a 5-year period, particularly because we are highly averse to issuing shares, an act that immediately juices net worth. There remain only a handful of companies in this country capable of truly moving the needle at Berkshire, and they have been endlessly picked over by us and by others. Some we can value, some we can't. And, if we can, they have to be attractively priced. Outside the U.S., there are essentially no candidates that are meaningful options for capital deployment at Berkshire. All in all, we have no possibility of eye-popping performance. Nevertheless, managing Berkshire is mostly fun and always interesting. On the positive side, after 59 years of assemblage, the company now owns either a portion or 100% of various businesses that, on a weighted basis, have somewhat better prospects than exist at most large American companies. By both luck and pluck, a few huge winners have emerged from a great many dozens of decisions. And we now have a small cadre of longtime managers who never muse about going elsewhere and who regard 65 as just another birthday. Berkshire benefits from an unusual constancy and clarity of purpose. While we emphasize treating our employees, communities and suppliers well, who wouldn't wish to do so? Our allegiance will always be to our country and our shareholders. We never forget that, though your money is commingled with ours, it does not belong to us. Leo. With that focus, and with our present mix of businesses, Berkshire should do a bit better than the average American corporation, and, more important, should also operate with materialist risk of permanent loss of capital. Anything beyond, slightly better though, is wishful thinking. This modest aspiration wasn't the case when Bertie went all in on Berkshire, but it is now, our not-so-secret weapon. Occasionally, markets or the economy will cause stocks and bonds of some large and fundamentally good businesses to be strikingly mispriced. Indeed, markets can, and will, unpredictably seize up or even vanish as they did for 4 months in 1914 and for a few days in 2001. If you believe that American investors are now more stable than in the past, think back to September 2008. Speed of communication and the wonders of technology facilitate instant worldwide paralysis, and we have come a long way since smoke signals. Such instant panics won't happen often, but they will happen. Berkshire's ability to immediately respond to market seizures with both huge sums and certainty of performance may offer us an occasional large-scale opportunity. Though the stock market is massively larger than it was in our early years, today's active participants are neither more emotionally stable nor better taught than when I was in school. For whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. The casino now resides in many homes and daily tempts the occupants. One fact of financial life should never be forgotten. Wall Street, to use the term in its figurative sense, would like its customers to make money, but what truly causes its denizens' juices to flow is feverish activity. At such times, whatever foolishness can be marketed will be vigorously marketed, not by everyone but always by someone. Occasionally, the scene turns ugly. The politicians then become enraged. The most flagrant perpetrators of misdeeds slip away, rich and unpunished, and your friend next door becomes bewildered, poorer, and sometimes vengeful. Money, he learns, has trumped morality. One investment rule at Berkshire has not and will not change. Never risk permanent loss of capital. Thanks to the American tailwind and the power of compound interest, the arena in which we operate has been, and will be, rewarding if you make a couple of good decisions during a lifetime and avoid serious mistake. I believe Berkshire can handle financial disasters of a magnitude beyond any heretofore experienced. This ability is one we will not relinquish. When economic upsets occur, as they will, Berkshire's goal will be to function as an asset to the country, just as it was in a very minor way in 2008-9, and to help extinguish the financial fire, rather than to be among the many companies that, inadvertently or otherwise, ignited the conflagration. Our goal is realistic. Berkshire's strength comes from its Niagara of diverse earnings delivered, after interest costs, taxes, and substantial charges for depreciation and amortization. EBITDA is a band measurement at Berkshire. We also operate with minimal requirements for cash, even if the country encounters a prolonged period of global economic weakness, fear, and near paralysis. Berkshire does not currently pay dividends, and its share repurchases are 100% discretionary. Annual debt maturities are never material. Your company also holds a cash and U.S. Treasury bill position far in excess of what conventional wisdom deems necessary. During the 2008 panic, Berkshire generated cash from operations and did not rely in any manner on commercial paper, bank lines, or debt markets. We did not predict the time of an economic paralysis, but we were always prepared for one. Extreme fiscal conservatism is a corporate pledge we make to those who have joined us in ownership of Berkshire. In most years, indeed in most decades, our caution will likely prove to be unneeded behavior, akin to an insurance policy on a fortress-like building thought to be fireproof. But Berkshire does not want to inflict permanent financial damage. Quotational shrinkage for extended periods can't be avoided, on Bertie or any of the individuals who have trusted us with their savings. Berkshire is built to last. Non-controlled businesses that leave us comfortable. Last year I mentioned two of Berkshire's long-duration partial ownership positions, Coca-Cola and American Express. These are not huge commitments like our Apple position, each only accounts for 4 to 5% of Berkshire's GAAP net worth. But they are meaningful assets and also illustrate our thought processes. American Express began operations in 1850, and Coca-Cola was launched in an Atlanta drugstore in 1886. Berkshire is not big on newcomers. Both companies tried expanding in town-related areas over the years, and both found little success in these attempts. In the past, but definitely not now, both were even mismanaged. But each was hugely successful in its base business, reshaped here and there as conditions called for. And crucially, their products traveled. Both Coke and Amex became recognizable names worldwide, as did their core products, and the consumption of liquids and the need for unquestioned financial trust are timeless essentials of our world. During 2023, we did not buy or sell a share of either Amex or Coke, extending our own Rip Van Winkle slumber that has now lasted well over 2 decades. Both companies again rewarded our inaction last year by increasing their earnings and dividends. Indeed, our share of Amex earnings in 2023 considerably exceeded the $1.3 billion cost of our long-ago purchase. Both Amex and Coke will almost certainly increase their dividends in 2024, about 16% in the case of Amex, and we will most certainly leave our holdings untouched throughout there. Could I create a better worldwide business than these two enjoy? As Bertie will tell you, no way. Though Berkshire did not purchase shares of either company in 2023, your indirect ownership of both Coke and Amex increased a bit last year because of share repurchases we made at Berkshire. Such repurchases work to increase your participation in every asset that Berkshire owns. To this obvious but often overlooked truth, I add my usual caveat. All stock repurchases should be price-dependent. What is sensible at a discount to business value becomes stupid if done at a premium. The lesson from Coke and Amex? When you find a truly wonderful business, stick with it. Patience pays, and one wonderful business can offset the many mediocre decisions that are inevitable. This year, I would like to describe 2 other investments that we expect to maintain indefinitely. Like Coke and Amex, these commitments are not huge relative to our resources. They are worthwhile, however, and we were able to increase both positions during 2023. At year-end, Berkshire owned 27.8% of Occidental Petroleum's common shares, and also owned warrants that, for more than 5 years, give us the option to materially increase our ownership at a fixed price. Though we very much like our ownership, as well as the option, Berkshire has no interest in purchasing or managing Occidental. We particularly like its vast oil and gas holdings in the United States, as well as its leadership in carbon capture initiatives, though the economic feasibility of this technique has yet to be proven. Both of these activities are very much in our country's interest. Not so long ago, The US was woefully dependent on foreign oil, and carbon capture had no meaningful constituency. Indeed, in 1975, U.S. production was 8 million barrels of oil equivalent per day, BOEPD, a level far short of the country's needs. From the favorable energy position that facilitated the U.S. mobilization in World War II, the country had retreated to become heavily dependent on foreign, potentially unstable, suppliers. Further declines in oil production were predicted along with future increases in usage. 9. For a long time, the pessimism appeared to be correct, with production falling to 5 million BOEPD by 2007. Meanwhile, the U.S. government created a Strategic Petroleum Reserve, SPR, in 1975 to alleviate, though not come close to eliminating, this erosion of American self-sufficiency. And then, hallelujah! Shale economics became feasible in 2011, and our interdependency ended. Now, U.S. production is more than 13 million BOEPD, and OPEC no longer has the upper hand. Occidental itself has annual U.S. oil production that each year comes close to matching the entire inventory of the SPR. Our country would be very, very nervous today if domestic production had remained at 5 million BOEPD, and it found itself hugely dependent in non-U.S. sources. At that level, the SPR would have been emptied within months if foreign oil became unavailable. Under Vicky Holub's leadership, Occidental is doing the right things for both its country and its owners. No one knows what oil prices will do over the next month, year, or decade. But Vicky does know how to separate oil from rock, and that's an uncommon talent, valuable to her shareholders and to her country. Additionally, Berkshire continues to hold its passive and long-term interest in 5 very large Japanese companies, each of which operates in a highly diversified manner somewhat similar to the way Berkshire itself is run. We increased our holdings in all 5 last year, after Greg Abel and I made a trip to Tokyo to talk with their managements. Berkshire now owns about 9% of each of the 5. A minor point. Japanese companies calculate outstanding shares in a manner different from the practice in the US. Berkshire has also pledged to each company that it will not purchase shares that will take our holdings beyond 9.9%. Our cost for the 5 totals yuan 6 trillion, and the year-end market value of the 5 was 2.9 yuan trillion. However, the yen has weakened in recent years and our year-end unrealized gain in dollars was 61%, or $8 billion. Neither Greg nor I believe we can forecast market prices of major currencies. We also don't believe we can hire anyone with this ability. Therefore, Berkshire has financed most of its Japanese position with the proceeds from 1.3 yuan trillion of bonds. This debt has been very well received in Japan, and I believe Berkshire has more yen-denominated debt outstanding than any other American company. The weakened yen has produced a year-end gain for Berkshire of $1.9 billion, a sum that, pursuant to GAAP rules, has periodically been recognized in income over the 2020-23 period. In certain important ways, all 5 companies, Itochu, Marubeni, Mitsubishi, Mitsui and Sumitomo, follow shareholder-friendly policies that are much superior to those customary practiced in the U.S. Since we began our Japanese purchases, each of the 5 has reduced the number of its outstanding shares at attractive prices. Meanwhile, the managements of all 5 companies have been far less aggressive about their own compensation than is typical in the United States. Note as well that each of the 5 is applying only about 1/3 of its earnings to dividends. The large sums the 5 retain are used both to build their many businesses and, to a lesser degree, to repurchase shares. Like Berkshire, the 5 companies are reluctant to issue shares. An additional benefit for Berkshire is the possibility that our investment may lead to opportunities for us to partner around the world with 5 large, well-managed and well-respected companies. Their interests are far more broad than ours. And, on their side, the Japanese CEO shaved the comfort of knowing that Berkshire will always possess huge liquid resources that can be instantly available for such partnerships, whatever their size may be. Our Japanese purchases began on the 4th of July 2019. Given Berkshire's present size, building positions through open market purchases takes a lot of patience and an extended period of friendly prices. The process is like turning a battleship. That is an important disadvantage, which we did not face in our early days at Berkshire. The scorecard in 2023. Every quarter we issue a press release that reports our summarized operating earnings, or loss, in a manner similar to what is shown below. Here is the full year compilation. At Berkshire's annual gathering on the 6th of May 2023, I presented the first quarter's results which had been released early that morning. I followed with a short summary of the outlook for the full year. 1. Most of our non-insurance businesses faced lower earnings in 2023. 2. That decline would be cushioned by decent results at our two largest non-insurance businesses, BNS and Berkshire Hathaway Energy, BHE, which combined had accounted for more than 30% of operating earnings in 2022. 3. Our investment income was certain to materially grow because the huge U.S. Treasury bill position held by Berkshire had finally begun to pay us far more than the pittance we had been receiving. And 4. Insurance would likely do well, both because its underwriting earnings are not correlated to earnings elsewhere in the economy, and beyond that, property casualty insurance prices had strengthened. Insurance came through as expected. I erred, however, in my expectations for both BNS and BHE. Let's take a look at each. Rail is essential to America's economic future. It is clearly the most efficient way, measured by cost, fuel usage, and carbon intensity, of moving heavy materials to distant destinations. Trucking wins for short hauls, but many goods that Americans need must travel to customers many hundreds, or even several thousands of miles away. The country can't run without rail, and the industry's capital needs will always be huge. Indeed, compared to most American businesses, railroads eat capital. BNSF is the largest of 6 major rail systems that blanket North America. Our railroad carries its 23,759 miles of main track, 99 tunnels, 13,495 bridges, 7,521 locomotives, and assorted other fixed assets at $70 billion on its balance sheet. But my guess is that it would cost at least $500 billion to replicate those assets and decades to complete the job. BNSF must annually spend more than its depreciation charge to simply maintain its present level of business. This reality is bad for owners, whatever the industry in which they have invested, but it is particularly disadvantageous in capital-intensive industries. At BNSF, the outlays in excess of GAAP depreciation charges since our purchase 14 years ago have totaled a staggering $22 billion, or more than $1.12 billion annually. Ouch! That sort of gap means BNSF dividends paid to Berkshire, its owner, will regularly fall considerably short of BNSF's reported earnings, unless we regularly increase the railroad's debt. And that we do not intend to do. Consequently, Berkshire is receiving an acceptable return on its purchase price, though less than it might appear, and also a pittance on the replacement value of the property. That's no surprise to me, or Berkshire's board of directors. It explains why we could buy BNSF in 2010 at a small fraction of its replacement value. North America's rail system moves huge quantities of coal, grain, autos, imported and exported goods, etc. one way for long distances, and those trips often create a revenue problem for backhauls. Weather conditions are extreme, and frequently hamper or even stymie the utilization of track, bridges, and equipment. Flooding can be a nightmare. None of this is a surprise. While is it in an always comfortable office, railroading is an outdoor activity with many employees working under trying and sometimes dangerous conditions. An evolving problem is that a growing percentage of Americans are not looking for the difficult, and often lonely, employment conditions inherent in some rail operations. Engineers must deal with the fact that among an American population of 335 million, some forlorn or mentally disturbed Americans are going to elect suicide by lying in front of a 100-car, extraordinarily heavy train that can't be stopped in less than a mile or more. Would you like to be the helpless engineer? This trauma happens about once a day in North America. It is far more common in Europe and will always be with us. Wage negotiations in the rail industry can end up in the hands of the President and Congress. Additionally, American railroads are required to carry many dangerous products every day that the industry would much rather avoid. The words, common carrier, define a railroad responsibilities. Last year, BNSF's earnings declined more than I expected, as revenues fell. Though fuel costs also fell, wage increases, promulgated in Washington, were far beyond the country's inflation goals. This differential may recur in future negotiations. Though BNSF carries more freight and spends more on capital expenditures than any of the 5 other major North American railroads, its profit margins have slipped relative to all 5 since our purchase. I believe that our vast service territory is second to none, and that therefore our margin comparisons can and should improve. I am particularly proud of both BNSF's contribution to the country and the people who work in sub-zero outdoor jobs in North Dakota and Montana winters to keep America's commercial arteries open. Railroads don't get much attention when they are working, but were they unavailable, the void would be noticed immediately throughout America. A century from now, BNSF will continue to be a major asset of the country and of Berkshire. You can count on that. Our second and even more severe earnings disappointment last year occurred at BHE. Most of its large electric utility businesses, as well as its extensive gas pipelines, performed about as expected. But the regulatory climate in a few states has raised the specter of zero profitability or revenue bankruptcy, an actual outcome at California's largest utility and a current threat in Hawaii. In such jurisdictions, it is difficult to project both earnings and asset values in what was once regarded as among the most stable industries in America. For more than a century, electric utilities raised huge sums to finance their growth through a state-by-state promise of a fixed return on equity, sometimes with a small bonus for superior performance. With this approach, massive investments were made for capacity that would likely be required a few years down the road. That forward-looking regulation reflected the reality that utilities build generating and transmission assets that often take many years to construct. BHE's extensive multi-state transmission project in the West was initiated in 2006 and remains some years from completion. Eventually, it will serve 10 states comprising 30% of the acreage in the continental United States. With this model employed by both private and public power systems, the lights stayed on, even if population growth or industrial demand exceeded expectations. The margin of safety approach seemed sensible to regulators, investors, and the public. Now, the fixed but satisfactory return pact has been broken in a few states, and investors are becoming apprehensive that such ruptures may spread. Climate change adds to their worries. Underground transmission may be required, but who, a few decades ago, wanted to pay the staggering costs for such construction? At Berkshire, we have made a best estimate for the amount of losses that have occurred. These costs arose from forest fires, whose frequency and intensity have increased, and will likely continue to increase, if convective storms become more frequent. It will be many years until we know the final tally from BHE's forest fire losses, and can intelligently make decisions about the desirability of future investments in vulnerable western states. It remains to be seen whether the regulatory environment will change elsewhere. Other electric utilities may face survival problems resembling those of Pacific Gas and Electric and Hawaiian Electric. A confiscatory resolution of our present problems would obviously be a negative for BHE, but both that company and Berkshire itself are structured to survive negative surprises. We regularly get these in our insurance business, where our basic product is risk assumption, and they will occur elsewhere. Berkshire can sustain financial surprises, but we will not knowingly throw good money after bad. Whatever the case at Berkshire, the final result for the utility industry may be ominous. Certain utilities might no longer attract the savings of American citizens and will be forced to adopt the public power model. Nebraska made this choice in the 1930 seconds, and there are many public power operations throughout the country. Eventually, voters, taxpayers, and users will decide which model they prefer. When the dust settles, America's power needs and the consequent capital expenditure will be staggering. I did not anticipate or even consider the adverse developments in regulatory returns and, along with Berkshire's two partners at BHE, I made a costly mistake in not doing so. Enough about problems. Our insurance business performed exceptionally well last year, setting records in sales, float, and underwriting profits. Property casualty insurance, PC, provides the core of Berkshire's well-being and growth. We have been in the business for 57 years, and despite our nearly 5,000-fold increase in volume, from $17 million to $83 billion, we have much room to grow. Beyond that, we have learned, too often, painfully, a good deal about what types of insurance business and what sort of people to avoid. The most important lesson is that our underwriters can be thin, fat, male, female, young, old, foreign, or domestic. But they can't be optimists at the office, however desirable that quality may generally be in life. Surprises in the PC business, which can occur decades after 6-month or 1-year policies have expired, are almost always negative. The industry's accounting is designed to recognize this reality, but estimation mistakes can be huge. And when charlatans are involved, detection is often both slow and costly. Berkshire will always attempt to be accurate in its estimates of future loss payments, but inflation, both monetary and the legal variety, is a wild card. I've told the story of our insurance operations so many times that I will simply direct newcomers to page 18. Here, I will only repeat that our position would not be what it is if Ajit Jain had not joined Berkshire in 1986. Before that lucky day, aside from an almost unbelievably wonderful experience with Geico that began early in 1951 and will never end, I was largely wandering in the wilderness as I struggled to build our insurance operation. Ajit's achievements since joining Berkshire have been supported by a large cast of hugely talented insurance executives in our various P.C. operations. Their names and faces are unknown to most of the press and the public. Berkshire's lineup of managers, however, is to P.C. Insurance what Cooperstown's honorees are to baseball. Bertie, you can feel good about the fact that you own a piece of an incredible P.C. operation that now operates worldwide with unmatched financial resources, reputation and talent. It carried the day in 2023. What is it with Omaha? Come to Berkshire's annual gathering on the 4th of May 2024. On stage you will see the three managers who now bear the prime responsibilities for steering your company. What, you may wonder, do the three have in common? They certainly don't look alike. Let's dive deeper. Greg Abel, who runs all non-insurance operations for Berkshire, and in all respects is ready to be CEO of Berkshire tomorrow, was born and raised in Canada. He still plays hockey. In the 1,990 seconds, however, Greg lived for 6 years in Omaha, just a few blocks away from me. During that period, I never met him. A decade or so earlier, Ajit Jain, who was born, raised and educated in India, lived with his family in Omaha, only a mile or so from my home, where I've lived since 1958. Both Ajit and his wife, Tinku, have many Omaha friends, though it's been more than 3 decades since they moved to New York, in order to be where much of the action in reinsurance takes place. Missing from the stage this year will be Charlie. He and I were both born in Omaha, about 2 miles from where you will sit at our May get-together. In his first 10 years, Charlie lived about a half-mile from where Berkshire has long maintained its office. Both Charlie and I spent our early years in Omaha public schools and were indelibly shaped by our Omaha childhood. We didn't meet, however, until much later. A footnote that may surprise you. Charlie lived under 15 of America's 45 presidents. People refer to President Biden as #46, but that numbering counts Grover Cleveland as both #20 and #24 because his terms were not consecutive. America is a very young country. Moving to the corporate level, Berkshire itself relocated in 1970 from its 81 years of residence in New England to settle in Omaha, leaving its troubles behind and blossoming in its new home. As a final punctuation point to the Omaha effect, Bertie, yes, that Bertie, spent her rarely formative years in a middle-class neighborhood in Omaha, and many decades later, emerged as one of the country's great investors. You may be thinking that she put all of her money in Berkshire and then simply sat on it. But that's not true. After starting a family in 1956, Bertie was active financially for 20 years, holding bonds, putting 1/3 of her funds in a publicly held mutual fund and trading stocks with some frequency. Her potential remained unnoticed. Then, in 1980, when 46, and independent of any urgings from her brother, Bertie decided to make her move. Retaining only the mutual fund in Berkshire, she made no new trades during the next 43 years. During that period, she became very rich, even after making large philanthropic gifts. Think 9 figures. Millions of American investors could have followed her reasoning, which involved only the common sense she had somehow absorbed as a child in Omaha. And, taking no chances, Bertie returns to Omaha every May to be re-energized. So what is going on? Is it Omaha's water? Is it Omaha's air? Is it some strange planetary phenomenon akin to that which has produced Jamaica's sprinters, Kenya's marathon runners, or Russia's chess experts? Must we wait until AI someday yields the answer to this puzzle? Keep an open mind. Come to Omaha in May, inhale the air, drink the water, and say hi to Bertie and her good-looking daughters. Who knows? There is no downside, and in any event, you will have a good time and meet a huge crowd of friendly people. To top things off, we will have available the new 4th edition of Poor Charlie's Almanac. Pick up a copy. Charlie's wisdom will improve your life as it has mine. February 24, 2024. Chairman of the Board. Berkshire's performance versus the S&P 500? Note: data are for calendar years with these exceptions. 1965 and 1966, year ended 9/30, 1967, 15 months ended 12/31. Berkshire Hathaway, Inc. To the shareholders of Berkshire Hathaway Incorporated. This letter comes to you as part of Berkshire's annual report. As a public company, we're required to periodically tell you many specific facts and figures. Report, however, implies a greater responsibility. In addition to the mandated data, we believe we owe you additional commentary about what you own and how we think. Our goal is to communicate with you in a manner that we would wish you to use if our positions were reversed. That is, if you were Berkshire's CEO while I and my family were passive investors, trusting you with our savings. This approach leads us to an annual recitation of both good and bad developments at the many businesses you indirectly own through your Berkshire shares. When discussing problem at specific subsidiaries, we do, however, try to follow the advice Tom Murphy gave to me 60 years ago. Praise by name, criticize by category. Mistakes, yes, we make them at Berkshire. Sometimes I've made mistakes in assessing the future economics of a business I've purchased for Berkshire. Each a case of capital allocation gone wrong. That happens with both judgments about marketable equities. We view these as partial ownership of businesses, and the 100% acquisitions of companies. At other times, I've made mistakes when assessing the abilities or fidelity of the managers Berkshire is hiring. The fidelity disappointments can hurt beyond their financial impact, a pain that can approach that of a failed marriage. A decent batting average in personnel decisions is all that can be hoped for. The cardinal sin is delaying the correction of mistakes, or what Charlie Munger called thumb-sucking. Problems, he would tell me, cannot be wished away. They require action, however uncomfortable that may be. During the 2019 to 23 period, I have used the words mistake or error 16 times in my letters to you. Many other huge companies have never used either word over that span. Amazon, I should acknowledge, made some brutally candid observations in its 2021 letter. Elsewhere, it has generally been happy talk and pictures. I have also been a director of large public companies at which mistake or wrong were forbidden words at board meetings or analyst calls. That taboo, implying managerial perfection, always made me nervous, though at times there could be legal issues that make limited discussion advisable. We live in a very litigious society. At 94, it won't be long before Greg Abel replaces me as CEO and will be writing the annual letters. Greg shares the Berkshire creed that a report is what a Berkshire CEO annual owes to owners. And he also understands that if you start fooling your shareholders, you will soon believe your own baloney and be fooling yourself as well. Pete Legal, one of a kind. Let me pause to tell you the remarkable story of Pete League, a man unknown to most Berkshire shareholders but one who contributed many billions to their aggregate wealth. Pettidied in November, still working at 80. I first heard of Forest River, the Indiana company Pete founded and managed, on June 21, 2005. On that day I received a letter from an intermediary detailing relevant data about the company, a recreational vehicle, RV, manufacturer. The writer said that Pete, the 100% owner of Forest River, specifically wanted to sell to Berkshire. He also told me the price that Pete expected to receive. I liked this no-nonsense approach. I did some checking with RV dealers, liked what I learned and arranged a June 28th meeting in Omaha. Pete brought along his wife, Sharon, and daughter Lisa. When we met, Pete assured me that he wanted to keep running the business but would feel more comfortable if he could assure financial security for his family. Pete next mentioned that he owned some real estate that was leased to Forest River and had not been covered in the June 21 letter. Within a few minutes, we arrived at a price for those assets, as I expressed no need for appraisal by Berkshire but would simply accept his valuation. Then we arrived at the other point that needed clarity. I asked Pete what his compensation should be, adding that whatever he said, I would accept. This, I should add, is not an approach I recommend for general use. Pete paused as his wife, daughter and I leaned forward. Then he surprised us. Well, he looked at Berkshire's proxy statement and I wouldn't want to make more than my boss, so pay him $100,000 per year. After I picked myself off the floor, Pete added, but we will earn X, he named a number this year, and I would like an annual bonus of 10% of any earnings above what the company is now delivering. I replied, okay Pete, but if Forest River makes any significant acquisitions, we will make an appropriate adjustment for the additional capital thus employed. It didn't define appropriate or significant, but those vague terms never caused a problem. The four of us then went to dinner at Omaha's Happy Hollow Club and lived happily ever after. During the next 19 years, Pete shot the lights out. No competitor came close to his performance. Every company doesn't have an easy-to-understand business, and there are very few owners or managers like Pete. And, of course, I expect to make my share of mistakes about the businesses Berkshire buys, and sometimes err in evaluating the sort of person with whom I'm dealing. But I've also had many pleasant surprises in both the potential of the business, as well as the ability and fidelity of the manager. And our experience is that a single winning decision can make a breathtaking difference over time. Think Geico as a business decision, Aji Chain as a managerial decision, and my luck in finding Charlie Munger as a one-of-a-kind partner, personal advisor and steadfast friend. Mistakes fade away. Winners can forever blossom. One further point in our CEO selections. I never look at where a candidate has gone to school. Never. Of course, there are great managers who attended the most famous schools. But there are plenty such as Pete who may have benefited by attending a less prestigious institution, or even by not bothering to finish school. Look at my friend, Bill Gates, who decided that it was far more important to get underway in an exploding industry that would change the world than it was to stick around for a parchment that he could hang on the wall. Read his new book, Source Code. Not long ago, I met, by phone, Jessica Tunkel, whose step-grandfather Ben Rosner long ago ran a business for Charlie and me. Ben was a retailing genius, and, in preparing for this report, I checked with Jessica to confirm Ben's schooling, which I remembered as limited. Jessica's reply: Ben never went past 6th grade. I was lucky enough to get an education at 3 fine universities. And I avidly believe in lifelong learning. I've observed, however, that a very large portion of business talent is innate with nature swamping nurture. Pete Legal was a natural. Last year's performance. In 2024, Berkshire did better than I expected, though 53% of our 189 operating businesses reported a decline in earnings. We were aided by a predictable large gain in investment income, as Treasury bill yields improved, and we substantially increased our holdings of these highly liquid short-term securities. Our insurance business also delivered a major increase in earnings, led by the performance of Geico. In 5 years, Todd Combs has reshaped Geico in a major way, increasing efficiency and bringing underwriting practices up to date. Geico was a long-held gem that needed major repolishing, and Todd has worked tirelessly in getting the job done. Though not yet complete, the 2024 improvement was spectacular. In general, property casualty, P.C., insurance pricing strengthened during 2024, reflecting a major increase in damage from convective storms. Climate change may have been announcing its arrival. However, no monster event occurred during 2024. Someday, any day, a truly staggering insurance loss will occur, and there is no guarantee that there will be only one per annum. The P.C. business is so central to Berkshire that it warrants a further discussion that appears later in this letter. Berkshire's railroad and utility operations, our 2 largest businesses outside of insurance, improved their aggregate earnings. Both, however, have much left to accomplish. Late in the year, we increased our ownership of the utility operation from about 92% to 100% at a cost of roughly $3.9 billion, of which $2.9 billion was paid in cash with a balance in Berkshire B shares. All told, we recorded operating earnings of $47.4 billion in 2024. We regularly, endlessly, some readers may groan, emphasize this measure rather than the GAAP-mandated earnings that are reported on page K68. Our measure excludes capital gains or losses on the stocks and bonds we own, whether realized or unrealized. Over time, we think it highly likely that gains will prevail. Why else would we buy these securities? Though the year-by-year numbers will swing wildly and unpredictably. Our horizon for such commitments is almost always far longer than a single year. In many, our thinking involves decades. These long-termers are the purchases that sometimes make the cash register ring like church bells. Here's a breakdown of the 2023-24 earnings as we see them. All calculations are after depreciation, amortization, and income tax. EBITDA, a flawed favorite of Wall Street, is not for us. Asterisk includes certain businesses in which Berkshire had between a 20% and 50% ownership, such as Kraft Heinz, Occidental Petroleum, and Berkshire. Asterisk includes foreign currency exchange gains of approximately $1.1 billion in 2024 and approximately $211 million in 2023, produced by our usage of non-US dollar-denominated debt. Surprise, surprise! An important American record is smashed. 60 years ago, present management took control of Berkshire. That move was a mistake, my mistake, and one that plagued us for 2 decades. Charlie, I should emphasize, spotted my obvious error immediately. Though the price I paid for Berkshire looked cheap, its business, a large northern textile operation, was headed for extinction. The U.S. Treasury, of all places, had already received silent warnings of Berkshire's destiny. In 1965, the company did not pay a dime of income tax, an embarrassment that had generally prevailed at the company for a decade. That sort of economic behavior may be understandable for glamorous startups, but it's a blinking yellow light when it happens at a venerable pillar of American industry. Berkshire was headed for the ash can. Fast forward 60 years and imagine the surprise at the Treasury when that same company, still operating under the name of Berkshire Hathaway, paid far more in corporate income tax than the U.S. government had ever received from any company, even the Americantech titans that commanded market values in the trillions. To be precise, Berkshire last year made 4 payments to the IRS that totaled $26.8 billion. That's about 5% of what all of corporate America paid. In addition, we paid sizable amounts for income taxes to foreign governments and to 44 states. Note one crucial factor allowing this record-shattering payment. Berkshire shareholders during the same 1965 to 2024 period received only one cash dividend. On the 3rd of January 1967, we disbursed our sole payment, $101,755 or 10 cents per A share. I can't remember why I suggested this action to Berkshire's board of directors. Now it seems like a bad dream. For 60 years, Berkshire shareholders endorsed continuous reinvestment, and that enabled the company to build its taxable income. Cash income tax payments to the U.S. Treasury, minuscule in the first decade, now aggregate more than $101 billion, and counting. Huge numbers can be hard to visualize. Let me recast the $26.8 billion that we paid last year. If Berkshire had sent the Treasury a $1 million check every 20 minutes throughout all of 2024, visualize 366 days and nights because 2024 was a leap year, we still would have owed the federal government a significant sum at year-end. Indeed, it would be well into January before the Treasury would tell us that we could take a short breather, get some sleep, and prepare for our 2025 tax payments. Where your money is. Berkshire's equity activity is ambidextrous. In one hand, we own control of many businesses, holding at least 80% of the investees' shares. Generally, we own 100%. These 189 subsidiaries have similarities to marketable common stocks but are far from identical. The collection is worth many hundreds of billions, and includes a few rare gems, many good but far from fabulous businesses, and some laggards that have been disappointments. We own nothing that is a major drag, but we have a number that I should not have purchased. In the other hand, we own a small percentage of a dozen or so very large and highly profitable businesses, with household names such as Apple, American Express, Coca-Cola and Moody's. Many of these companies earn very high returns on the net tangible equity required for their operations. At year-end, our partial ownership holdings were valued at $272 billion. Understandably, really outstanding businesses are very seldom offered in their entirety, but small fractions of these gems can be purchased Monday through Friday on Wall Street, and, very occasionally, they sell at bargain prices. We are impartial in our choice of equity vehicles, investing in either variety based upon where we can best deploy your, and my family's, savings. Often, nothing looks compelling. Very infrequently we find ourselves knee-deep in opportunities. Greg has vividly shown his ability to act at such times, as did Charlie. With marketable equities, it is easier to change course when I make a mistake. Berkshire's present size, it should be underscored, diminishes this valuable option. We can't come and go on a dime. Sometimes a year or more is required to establish or divest an investment. Additionally, with ownership of minority positions, we can't change management if that action is needed, or control what is done with capital flows if we are unhappy with the decisions being made. With controlled companies, we can dictate these decisions, but we have far less flexibility in the disposition of mistakes. In reality, Berkshire almost never sells controlled businesses unless we face what we believe to be unending problems. An offset is that some business owners seek out Berkshire because of our steadfast behavior. Occasionally, that can be a decided plus for us. Despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities. That preference won't change. While our ownership in marketable equities moved downward last year, from $354 billion to $272 billion, the value of our non-quoted controlled equities increased somewhat and remains far greater than the value of the marketable portfolio. Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance. Berkshire will never prefer ownership of cash-equivalent assets over the ownership of good businesses, whether controlled or only partially owned. Paper money can see its value evaporate if fiscal folly prevails. In some countries, this reckless practice has become habitual, and, in our country's short history, the U.S. has come close to the edge. Fixed coupon bonds provide no protection against runaway currency. Businesses, as well as individuals with desired talents, however, will usually find a way to cope with monetary instability as long as their goods or services are desired by the country's citizenry. So too, with personal skills. Lacking such assets as athletic excellence, a wonderful voice, medical or legal skills, or, for that matter, any special talents, I have had to rely on equities throughout my life. In effect, I have depended on the success of American businesses, and I will continue to do so. One way or another, the sensible, better yet imaginative, deployment of savings by citizens is required to propel an ever-growing societal output of desired goods and services. This system is called capitalism. It has its faults and abuses, in certain respects more egregious now than ever, but it also can work wonders unmatched by other economic systems. America is Exhibit A. Our country's progress over its mere 235 years of existence could not have been imagined by even the most optimistic colonists in 1789, when the Constitution was adopted and the country's energies were unleashed. True, our country in its infancy sometimes borrowed abroad to supplement our own savings. But, concurrently, we needed many Americans to consistently save, and then needed those savers, or other Americans, to wisely deploy the capital thus made available. If America had consumed all that it produced, the country would have been spinning its wheels. The American process has not always been pretty. Our country has forever had many scoundrels and promoters who seek to take advantage of those who mistakenly trust them with their savings. But even with such malfeasance, which remains in full force today, and also much deployment of capital that eventually floundered because of brutal competition or disruptive innovation, the savings of Americans has delivered a quantity and quality of output beyond the dreams of any colonist. From a base of only 4 million people, and despite a brutal internal war early on, pitting one American against another, America changed the world in the blink of a celestial eye. In a very minor way, Berkshire shareholders have participated in the American miracle by foregoing dividends, thereby electing to reinvest rather than consume. Originally, this reinvestment was tiny, almost meaningless, but over time, it mushroomed, reflecting the mixture of a sustained culture of savings, combined with the magic of long-term compounding. Berkshire's activities now impact all corners of our country, and we are not finished. Companies die for many reasons, but, unlike the fate of humans, old age itself is not lethal. Berkshire today is far more youthful than it was in 1965. However, as Charlie and I have always acknowledged, Berkshire would not have achieved its results in any locale except America, whereas America would have been every bit the success it has been if Berkshire had never existed. So thank you, Uncle Sam. Someday your nieces and nephews at Berkshire hope to send you even larger payments than we did in 2024. Spend it wisely. Take care of the many who, for no fault of their own, get the short straws in life. They deserve better. And never forget that we need you to maintain a stable currency, and that result requires both wisdom and vigilance on your part. Property casualty insurance, P&C insurance, continues to be Berkshire's core business. The industry follows a financial model that is rare, very rare, among giant businesses. Customarily, companies incur costs for labor, materials, inventories, plant and equipment, etc. before, or concurrently with, the sale of their products or services. Consequently, their CEOs have a good fix on knowing the cost of their product before they sell it. If the selling price is less than its cost, managers soon learn they have a problem. Hemorrhaging cash is hard to ignore. When writing P&C insurance, we receive payment up front, and much later learn what our product has cost us. sometimes a moment of truth that is delayed as much as 30 or more years. We are still making substantial payments on asbestos exposures that occurred 50 or more years ago. This mode of operations has the desirable effect of giving P.C. insurers cash before they incur most expenses, but carries with it the risk that the company can be losing money, sometimes mountains of money, before the CEO and directors realize what is happening. Certain lines of insurance minimize this mismatch, such as crop insurance or hail damage, in which losses are quickly reported, evaluated, and paid. Other lines, however, can lead to executive and shareholder bliss as the company is going broke. Think coverages such as medical malpractice or product liability. In long-tail lines, a P.C. insurer may report large but fictitious profits to its owners and regulators for many years, even decades. The accounting can be particularly dangerous if the CEO is an optimist or a crook. These possibilities are not fanciful. History reveals a large number of each species. In recent decades, this money up front, loss payments later model has allowed Berkshire to invest large sums, float, while generally delivering what we believe to be a small underwriting profit. We make estimates for surprises, and, so far, these estimates have been sufficient. We are not deterred by the dramatic and growing loss payments sustained by our activities. As I write this, think wildfires. It's our job to price to absorb these and unemotionally take our lumps when surprises develop. It's also our job to contest runaway verdicts, spurious litigation, and outright fraudulent behavior. Under Agit, our insurance operation has blossomed from an obscure Omaha-based company into a world leader, renowned for both its taste for risk and its Gibraltar-like financial strength. Moreover, Greg, our directors and I all have a very large investment in Berkshire in relation to any compensation we receive. We do not use options or other one-sided forms of compensation. If you lose money, so do we. This approach encourages caution but does not ensure foresight. P.C. insurance growth is dependent on increased economic risk. No risk, no need for insurance. Think back only 135 years when the world had no autos, trucks, or airplanes. Now there are 300 million vehicles in the US alone, a massive fleet causing huge damage daily. Property damage arising from hurricanes, tornadoes, and wildfires is massive, growing and increasingly unpredictable in their patterns and eventual costs. It would be foolish, make that madness, to write 10-year policies for these coverages, but we believe 1-year assumption of such risks is generally manageable. If we change our minds, we will change the contracts we offer. During my lifetime, auto insurers have generally abandoned 1-year policies and switched to the 6-month variety. This change reduced float but allowed more intelligent underwriting. No private insurer has the willingness to take on the amount of risk that Berkshire can provide. At times, this advantage can be important. But we also need to shrink when prices are inadequate. We must never write inadequately priced policies in order to stay in the game. That policy is corporate suicide. Properly pricing P.C. insurance is part art, part science, and is definitely not a business for optimists. Mike Goldberg, the Berkshire executive who recruited Ajit, said it best. We want our underwriters to daily come to work nervous, but not paralyzed. All things considered, we like the P.C. insurance business. Berkshire can financially and psychologically handle extreme losses without blinking. We are also not dependent on reinsurer sand, that gives us a material and enduring cost advantage. Finally, we have outstanding managers, no optimists, and are particularly well situated to utilize the substantial sums P.C. insurance delivers for investment. Over the past 2 decades, our insurance business has generated $32 billion of after-tax profits from underwriting, about 3.3 cents per dollar of sales after income tax. Meanwhile, our float has grown from $46 billion to $171 billion. The float is likely to grow a bit over time, and, with intelligent underwriting, and some luck, has a reasonable prospect of being costless. Berkshire increases its Japanese investments. A small but important exception to our US-based focus is our growing investment in Japan. It's been almost 6 years since Berkshire began purchasing shares in 5 Japanese companies that very successfully operate in a manner somewhat similar to Berkshire itself. The 5 are, alphabetically, Itoku, Marubeni, Mitsubishi, Mitsui, and Sumitomo. Each of these large enterprises, in turn, owns interests in a vast array of businesses, many based in Japan but others that operate throughout the world. Berkshire made its first purchases involving the 5 in July 2019. We simply looked at their financial records and were amazed at the low prices of their stocks. As the years have passed, our admiration for these companies has consistently grown. Greg has met many times with them, and I regularly follow their progress. Both of us like their capital deployment, their managements, and their attitude in respect to their investors. Each of the 5 companies increase dividends when appropriate, they repurchase their shares when it is sensible to do so, and their top managers are far less aggressive in their compensation programs than their U.S. counterparts. Our holdings of the 5 are for the very long term, and we are committed to supporting their boards of directors. From the start, we also agreed to keep Berkshire's holdings below 10% of each company's shares. But, as we approached this limit, the 5 companies agreed to moderately relax the ceiling. Over time, you will likely see Berkshire's ownership of all 5 increase somewhat. At year-end, Berkshire's aggregate cost, in dollars, was $13.8 billion, and the market value of our holdings totaled $23.5 billion. Meanwhile, Berkshire has consistently, but not pursuant to any formula, increased its yen-denominated borrowings. All are at fixed rates, no floaters. Greg and I have no view on future foreign exchange rates and therefore seek a position approximating currency neutrality. We are required, however, under GAAP rules to regularly recognize in our earnings a calculation of any gains or losses in the yen we have borrowed, and, at year-end, had included $2.3 billion off after-tax gains due to dollar strength, of which $850 million occurred in 2024. I expect that Greg and his eventual successors will be holding this Japanese position for many decades, and that Berkshire will find other ways to work productively with the 5 companies in the future. We like the current math of our yen balance strategy as well. As I write this, the annual dividend income expected from the Japanese investments in 2025 will total about $812 million. The interest cost of our yen-denominated debt will be about $135 million. The annual gathering in Omaha. I hope you will join us in Omaha on May 3rd. We are following a somewhat changed schedule this year, but the basics remain the same. Our goal is that you get many of your questions answered, that you connect with friends, and that you leave with a good impression of Omaha. The city looks forward to your visits. We will have much the same group of volunteers to offer you a wide variety of Berkshire products that will lighten your wallet and brighten your day. As usual, we will be open on Friday from noon until 5 p.m., with lovable squishmallows, underwear from Fruit of the Loom, Brooks running shoes, and a host of other items to tempt you. Again, we will have only one book for sale. Last year we featured Poor Charlie's Almanac and sold out. 5,000 copies disappeared before the close of business on Saturday. This year we will offer 60 years of Berkshire Hathaway. In 2015, I asked Carrie Sova, who among her many duties managed much of the activity at the annual meeting, to try her hand at putting together a light-hearted history of Berkshire. I gave her full rein to use her imagination, and she quickly produced a book that blew me away with its ingenuity, contents and design. Subsequently, Carrie left Berkshire to raise a family and now has 3 children. But each summer, the Berkshire office force gets together to watch the Omaha Storm Chasers play baseball against a AAA opponent. I ask a few alums to join us, and Carrie usually comes with her family. At this year's event, I brazenly asked her if she would do a 60th anniversary issue, featuring Charlie's photos, quotes, and stories that have seldom been made public. Even with 3 young children to manage, Carrie immediately said yes. Consequently, we will have 5,000 copies of the new book available for sale on Friday afternoon and from 7 a.m. to 4 p.m. on Saturday. Carrie refused any payment for her extensive work on the new Charlie edition. I suggested she and I co-sign 20 copies to be given to any shareholder contributing $5,000 to the Stevens Center that serves homeless adults and children in South Omaha. The Kaiser family, beginning with Bill Kaiser, Sr., my longtime friend and Carrie's grandfather, have for decades been assisting this worthy institution. Whatever is raised through the sale of the 20 autographed books, I will match. Becky Quick will cover our somewhat re-engineered gathering on Saturday. Becky knows Berkshire like a book and always arranges interesting interviews with managers, investors, shareholders, and an occasional celebrity. She and her CNBC crew do a great job of both transmitting our meetings worldwide and archiving much Berkshire-related material. Give our director, Steve Burke, credit for the archive idea. We will not have a movie this year but rather will convene a bit earlier at 8 a.m. I will make a few introductory remarks, and we will promptly get to the Q&A, alternating questions between Becky and the audience. Greg and Ajit will join me in answering questions, and we will take a half-hour break at 10:30 a.m. When we reconvene at 11 a.m., only Greg will join me on stage. This year, we will disband at 1 p.m., but stay open for shopping in the exhibit area until 4 p.m. You can find the full details regarding weekend activities on page 16. Note, particular the always popular Brooks Run on Sunday morning. I will be sleeping. My wise and good-looking sister, Bertie, of whom I wrote last year, will be attending the meeting along with 2 of her daughters, both good-looking as well. Observers all agree that the genes producing this dazzling result flow down only the female side of the family. Sob. Bertie is now 91, and we talk regularly on Sundays using old-fashioned telephones for communications. We cover the joys of old age and discuss such exciting topics as the relative merits of our canes. In my case, the utility is limited to the avoidance of falling flat on my face. But Bertie regularly one-ups me by asserting that she enjoys an additional benefit. When a woman uses a cane, she tells me men quit hitting on her. Bertie's explanation is that the maligo is such that little old ladies with canes simply aren't an appropriate target. Presently, I have no data to counter her assertion, but I have suspicions. At the meeting I can't see much from the stage, and I would appreciate it if attendees would keep an eye on Bertie. Let me know if the cane is really doing its job. My bet is that she will be surrounded by males. For those of a certain age, the scene will bring back memories of Scarlett O'Hara and her horde of male admirers in Gone with the Wind. The Berkshire directors and I immensely enjoy having you come to Omaha, and I predict that you will have a good time and likely make some new friends. February 22, 2025, Chairman of the Board. Berkshire's performance versus the S&P 500. Note: data are for calendar years with these exceptions: 1965 and 1966, year ended 9/30, 1967, 15 months ended 12/31. Berkshire's performance versus the S&P 500.